It seems like 2024 and 2025 are going to be great years for the stock market, and some of the hottest sectors are going to continue to outperform. And in this video, we're going to share with you those data. So the chart right now shows you the S&P 500 annual earning growth of different calendar years. The growth rate was only at 1% for the most recent year, which is 2023. But what's very interesting is what's going to happen in the next 2 years. So in calendar year 2024, the Wall Street are expecting S&P 500 to have a gain, earnings gain of 11.3%. And in 2025, they're expecting a earnings gain of 14.4%. So if that does play out the way it's expected, it's going to be the third time in the past 15 years that S&P 500 has reported 2 consecutive years of double-digit earnings growth. And the last time this happened was in 2017 with a 11.5% growth, and 2018 with a 20.3% growth. And the time before last time was 2010 with 40.2% annual growth, and 2011 with 12.8% growth. So how was the S&P 500 price performance when it happened twice in the past 15 years? The return actually wasn't that great, because in 2010 to 2011, that's a 2-year span, right? The S&P 500 only had a growth of 9.9% in terms of the price. And in 2017 and 18, that's a 2-year span, the S&P 500 growth was only 11%. But the average annual return of S&P 500 is actually 10%. So for a 2-year span, it's supposed to give us a return of 21%. So why was the return so low during the 2 time periods? Is because there was some black swan events. For example, in 2011, as you can see, there's some turbulence. That's because of the European sovereign debt crisis. And also during the same time, S&P downgraded U.S. credit rating, right? So the country's credit rating was downgraded for the first time in the history of the United States. That caused a lot of fear in the market, causing turbulence in S&P performance. And also in 2018, that turbulence was caused by the quantitative tightening that was applied on June 4th, 2018. This is the first time Federal Reserve ever done the quantitative tightening. Of course, it caused a lot of fear in the market as well. So in the year 2024, what sectors are going to drive the growth of S&P 500? As you can see, 9 out of 11 sectors are going to see growth, and 2 of the sectors are going to see earnings shrink. The leader of the growth are going to be communication services being number 1, and we have technology sector. And number 4, we have consumer discretionaries like Amazon, like Nike, right? And the two sectors that's going to see earnings shrink are materials and energy. So probably they're projecting that the oil price, the crude oil, are gonna go down along with the inflation numbers, right? So in 2025, as we can see, all 11 sectors are projected to grow. Okay, and the leader is technology, and number 2 will be healthcare, and number 4. Consumer discretionaries, and we have communication services at number 7. Okay, so by looking at all these data, what we can see is that technology are going to be a key driver for the growth of the next 2 years, right? So probably AI is going to continue to be the narrative. Probably semiconductor sectors related to AI are going to continue to see strong earnings growth, right? And even though strong earnings growth of the S&P 500, companies doesn't necessarily guarantee a strong price of the S&P 500 performance because black swan events are uncontrollable But we have to say that having a positive expectation for the earnings growth for corporate America should be perceived as a positive catalyst. And it's very important to also for the retail investors to stay exposed to the stock market. You do not want to be underexposed, because underexposure to stock market is also a risk, because you're risking yourself not making money. Right? Investing in this kind of market environment, I think another key element is to stay diversified, right? Since we know that technology is going to be one of the key drivers and is going to continue to dominate, I think QQQ is a very advantageous tool and a very attractive ETF because it's heavy in debt, heavy in tech, and heavy in communication services and consumer discretionaries. This ETF is going to help you diversify across different growth stocks. And it's very important to diversify not only across different stocks, but also across different asset types, because as the stock market continue to go strong, assuming that's the case, the real estate price will likely to continue to go strong as well due to the wealth effect propping up the demand for the real estate. I think it's also important for the retail investors have a certain percentage of their portfolio in cash equivalent, such as short-term bonds or money market funds, because even though Federal Reserve is projecting the lower interest rate in the second half of this year, and which is going to negatively affect your fixed income product, but the safety net that those short-term fixed income product going to provide to you is invaluable. Thank you very much. Please don't forget to subscribe.